When news broke that China had quietly dumped nearly 660 tons of silver onto the global market, most investors barely noticed at first. But behind the scenes, this move sent shockwaves through commodity desks, bullion banks, and governments that depend on precious metals for far more than jewelry or electronics. Because silver is not just another metal, it is a strategic asset tied to energy, technology, and monetary confidence. And what made this event truly extraordinary was not just the sheer size of the dump, but the timing and what came next. Because after effectively locking up supply and pressuring prices, Beijing suddenly reversed course, leaving analysts scrambling to understand what China was really trying to achieve. And to grasp the significance of this decision, we need to step back and look at how silver fits into China, guess broader economic and geopolitical strategy, why accumulating and releasing silver matters, and how this single move could reshape global markets in ways most people are still underestimating. For years, China has been steadily increasing its influence over key commodities, from rare earth elements to copper, lithium, and industrial metals. But silver occupies a unique position because it straddles two worlds. It is both a monetary metal with thousands of years of history and a critical industrial input essential for solar panels, electric vehicles, medical devices, and advanced electronics, which means any large-scale intervention by a major player like China has ripple effects that go far beyond simple supply. And demand charts leading up to the dump, China had been quietly absorbing silver through state-linked entities, domestic production, and strategic imports. At the same time, Western inventories were tightening. Industrial demand was rising, and investment demand remained stubbornly resilient. Despite higher interest rates, this combination created a market that was increasingly fragile, where even a small disruption could trigger outsized price movements. And China knew this by accumulating silver while keeping its intentions opaque. Beijing effectively positioned itself as a silent market maker, able to influence price direction without ever issuing a public statement. Then came the dump 660 tons released into the market in a relatively compressed time frame, which applied immediate downward pressure on prices, catching leverage traders off guard and forcing liquidations for short-term observers. This looked like a straightforward attempt to suppress prices, but that interpretation misses the deeper strategic layer. Because dumping silver at that scale is not something a rational actor does without a clear objective, especially when silver also supports China's own industrial ambitions. The key lies in understanding market psychology and control. By flooding the market, China created the perception of abundance at a moment when the underlying fundamentals were still tight. This perception shift matters because markets trade on expectations as much as on reality. Once prices began to fall, sentiment flipped. Speculative longs exited, volatility spiked, and confidence weakened, effectively allowing China to reset the market on its own terms. But just as participants began to price in a prolonged period of weakness, Beijing reversed course, halting further sales and allowing the market to stabilize. This sudden change is what truly raised alarms, because it suggested that the dump was never about exiting silver altogether, but about engineering a specific outcome, and that outcome appears to be control rather than profit. By forcing prices lower temporarily, China could secure cheaper silver for downstream industries, renegotiate long-term supply contracts, and stress test Western inventories to see how resilient they really were. And once that information was gathered and those objectives were met, continuing to dump would no longer make sense, especially if it risked undermining China's own strategic reserves. This is where the story becomes less about silver itself and more about the shifting balance of power in global commodity markets. China is demonstrating that it can act not just as a consumer or producer, but as an active architect of market behavior, capable of shaping narratives, flushing out weak hands, and then stepping back before the damage becomes systemic. For investors watching from the outside, this raises uncomfortable questions about transparency, fairness, and risk. Because when a state actor with vast resources and long-term objectives intervenes, traditional market signals become distorted, and price no longer reflects pure fundamentals. Instead, it reflects strategy. And silver may be one of the clearest examples yet of how this new era of commodity management is unfolding. But to fully understand why China reversed course so abruptly, we need to look deeper into what was happening behind the scenes at the same time, from energy policy shifts to currency considerations and the fragile state of global trust in financial systems. Because silver, in this context, is not just a metal, it is a message. And in the next part, we will break down what that message likely was, who it was aimed at, and why the rest of the world may have misread it entirely. To understand why China's reversal mattered as much as the dump itself, we need to examine the broader macroeconomic backdrop unfolding at the same time, because this move did not happen in isolation. It coincided with growing stress in global supply chains, rising geopolitical fragmentation, and a subtle but persistent shift away from dollar-centric systems, all of which directly influence how a country like China manages strategic resources. Silver, in particular, plays a quiet but crucial role in energy transition goals, and China is the undisputed leader in solar manufacturing, producing the majority of the world's photovoltaic panels, each of which relies on silver for conductivity, efficiency, and durability. Even incremental changes in silver pricing can significantly impact production costs at scale. So by temporarily pushing prices down, China effectively reduced input costs for one of its most important strategic industries, strengthening its competitive advantage while foreign producers faced higher relative costs and thinner margins. At the same time, this maneuver put pressure on Western silver inventories, which have been steadily declining across major exchanges. By releasing a large volume and then stopping abruptly, China forced the market to reveal where the real shortages were hiding, which vaults could meet delivery, which contracts relied heavily on paper claims rather than physical metal, and how quickly stress would emerge if supply tightened again. This information is invaluable to a strategic planner. Far more valuable than short-term trading profits, because it exposes structural weaknesses that can be exploited later. Another overlooked factor is currency dynamics. Silver, like gold, acts as a hedge against monetary instability, and while gold dominates headlines, silver's dual role makes it especially sensitive to shifts in confidence. China has been actively working to internationalize its currency and reduce reliance on the US dollar in trade settlements. Maintaining influence over precious metals markets supports that goal by offering alternatives to dollar-based value storage. Dumping silver during a period of global uncertainty can temporarily undermine its appeal as a safe haven, reinforcing confidence in fiat systems just long enough to stabilize conditions while longer-term plans continue quietly in the background. But once that objective is achieved, reversing course becomes essential, because a prolonged suppression of silver prices could eventually backfire, discouraging mining investment and tightening future supply, which would drive prices sharply higher and potentially destabilize industrial planning. China's planners are acutely aware of these second-order effects, which is why the reversal was not a sign of confusion or panic, but of precision. It marked the moment when the market had been sufficiently reshaped, and further intervention would yield diminishing returns. There is also a geopolitical signaling aspect that cannot be ignored. By executing a move of this scale without prior warning, and then stepping back, China demonstrated to both allies and rivals that it possesses not only the resources but the discipline to intervene decisively and then withdraw. This contrasts sharply with more reactive policy approaches seen elsewhere, where interventions often escalate or linger too long, creating unintended consequences for institutional investors and governments. This sends a clear message that markets once considered too deep or too liquid to be influenced by a single actor are no longer immune. And that assumption alone forces a recalibration of risk models, hedging strategies, and long-term planning. Meanwhile, retail investors were largely left in the dark, reacting to price movements without visibility into the strategic forces driving them, which underscores a growing divide between price action and price understanding. In this environment, volatility becomes less about randomness and more about choreography, and silver's sudden swings are a perfect example. They appear chaotic on the surface, but reveal structure when viewed through a strategic lens. And this brings us to a critical question. If China was able to manipulate sentiment and pricing so effectively once, what prevents it from doing so again, or applying similar tactics to other markets that are even more critical to global stability? The answer lies in coordination, timing, and the willingness of other actors to adapt. Because while China can move markets, it cannot control outcomes indefinitely, especially as its actions become more visible and predictable. However, the silver episode shows that many participants are still operating with outdated assumptions about how markets function in a multipolar world, assuming transparency where opacity is the norm, and equilibrium where strategic imbalance is increasingly deliberate. In the next part, we will explore how this event fits into a broader pattern of resource nationalism and market signaling, and what it means for the future of silver prices, investment strategies, and the fragile trust that underpins global trade itself. What makes the silver episode especially important is that it does not stand alone. It fits into a much broader pattern of how strategic resources are increasingly being used as tools of influence rather than merely commodities traded for profit. Over the past decade, we have seen a gradual shift toward resource nationalism, where countries seek not only to secure supply for themselves, but to shape global access, pricing, and dependency. China has been at the forefront of this shift, particularly in markets where concentration of production or processing creates leverage. Silver is not as geographically concentrated as rare earths, but the infrastructure surrounding it, refining capacity, inventory storage, and industrial consumption is heavily influenced by a small number of players, which creates opportunities for intervention that are subtle yet powerful. By demonstrating an ability to move the silver market without triggering regulatory backlash or coordinated responses, China effectively tested the limits of what is possible in today's fragmented global system, and the lack of a strong counterreaction suggests those limits are wider than many assumed. This has profound implications for future price behavior, because it means silver may no longer trade purely on traditional cycles of mining output, industrial demand, and investor sentiment. Instead, it may increasingly reflect strategic timing, policy objectives, and geopolitical signaling. This does not eliminate fundamentals, but it does distort them, creating periods where prices appear disconnected from reality until the underlying tension becomes impossible to contain. For investors, this environment rewards patience and understanding over short-term speculation. Those who chased the price drop during the dump may have believed they were reacting rationally, but without insight into why the move was happening, they were essentially trading blind. While those with a longer horizon and a deeper grasp of structural forces were better positioned to interpret the reversal as a warning rather than a relief. Another critical factor is the impact on mining investment. Silver mining is often a byproduct of other metals like copper, lead, and zinc, which means supply does not respond quickly to price signals. When prices are artificially suppressed, even temporarily, it can delay new projects, reduce exploration budgets, and tighten future supply in ways that only become visible years later. China understands this dynamic well, and by intervening briefly, rather than continuously, it avoids triggering an immediate supply response, while still benefiting from lower prices in the near term. This creates a setup where future scarcity becomes more likely, not less, which raises the possibility that today, S price weakness is laying the groundwork for tomorrow. S volatility, and when silver eventually moves higher, it may do so abruptly, catching the market off guard once again. There's also a psychological dimension to consider. Silver has long been viewed as the more volatile, less respected sibling of gold, prone to sharp swings and speculative excess. Events like this reinforce that reputation, discouraging conservative investors and pushing participation towards shorter-term traders. But that very perception creates vulnerability, because markets dominated by speculative flows are easier to push around, making them attractive targets for strategic actors. The irony is that silver's volatility, often cited as a weakness, may actually be what makes it so useful as a signaling tool, allowing interventions to have outsized effects with relatively modest resources compared to larger markets like oil or sovereign bonds. As we zoom out further, the silver dump and reversal can be seen as a rehearsal, a controlled experiment designed to observe reactions, measure resilience, and refine tactics. It answers questions about how quickly prices move, how institutions respond, and how narratives form in real time. This kind of information is priceless in a world where economic competition increasingly overlaps with national security, and it suggests that future interventions may be more targeted, more frequent, and harder to interpret, not just in silver, but across a range of strategic materials essential to modern economies for governments outside China. This presents a dilemma: respond too aggressively and risk escalating tensions, or do nothing and implicitly accept a new normal where markets are shaped by strategic intent rather than collective equilibrium. So far, the response has leaned toward silence, but silence itself is a signal, one that tells sophisticated actors that the field remains open. For individual investors and businesses, the lesson is sobering but empowering. Markets are no longer just numbers on a screen. They are expressions of power, priorities, and long-term plans that unfold slowly and then all at once. Understanding that does not guarantee profits, but it does reduce surprise. And in the next part, we will examine what this shift means for the future trajectory of silver, how similar moves could play out again, and what signals to watch for before the next major turn catches the market unprepared. Looking ahead, the future trajectory of silver becomes less about predicting a specific price level and more about understanding the conditions under which sudden moves are likely to occur. Because the lesson from China's 660-ton intervention is not that silver is permanently controlled, but that it is increasingly sensitive to strategic timing. One of the most important signals to watch is inventory behavior rather than headline prices, when visible stocks on major exchanges decline quietly while prices remain subdued. It often indicates that physical demand is being met off-market or through long-term contracts, reducing the buffer that normally absorbs shocks. This kind of divergence creates a fragile equilibrium, where a relatively small disruption can trigger a sharp repricing. China's temporary dump exploited exactly this condition, pushing prices lower while the physical cushion was already thinning. And once that cushion is sufficiently eroded, reversing course becomes not only logical but necessary to avoid unintended consequences. Another key signal lies in industrial policy announcements, especially related to renewable energy, electric vehicles, and grid infrastructure. Any acceleration in these areas increases structural demand for silver. And when such demand is politically prioritized, price becomes a secondary concern. If Beijing or other major governments commit to aggressive timelines or subsidies, it implies a need to secure inputs regardless of market volatility, which can quickly tighten supply behind the scenes. Currency policy is another critical layer. Periods of stress in fiat systems often revive interest in precious metals, even when official narratives downplay inflation or financial risk. Silver tends to lag gold initially, but then catch up violently once confidence erodes. China's maneuver may have delayed this process temporarily by disrupting sentiment, but it did not eliminate the underlying drivers. It merely bought time. And time is a strategic resource in itself, allowing policymakers to align industrial, monetary, and geopolitical objectives more effectively for investors. This environment calls for a shift in mindset rather than reacting to every price swing. The focus should be on structure, who controls supply, who consumes at scale, and who has the ability to act without transparency. Silver ES role as both an industrial input and a monetary hedge makes it uniquely exposed to these forces, and uniquely informative as an indicator of broader systemic stress. When silver behaves erratically without a clear fundamental trigger, it often signals deeper tensions that have not yet surfaced elsewhere. This makes it less suitable for casual speculation, but more valuable as a barometer. Another important consideration is how narratives form after events like this. Once the immediate volatility fades, the story is often simplified, framed as a one-off anomaly or an overreaction. But this kind of framing obscures the strategic lessons and leaves participants vulnerable to repetition. The fact that China reversed course does not mean the risk is gone. It means the experiment has concluded, and the data has been collected. Future interventions may be smaller, faster, and less visible, making them harder to identify in real time. This places a premium on preparation rather than prediction, understanding the incentives of major players, the constraints they face, and the signals they inadvertently reveal through their actions. Ultimately, the silver dump was not a sign of weakness or indecision. It was a demonstration of optionality, the ability to move, pause, and move again without committing to a single narrative in a world of rising fragmentation and declining trust. That kind of flexibility is power. And silver, because of its unique position in the global economy, is likely to remain one of the arenas where that power is tested. The real risk for the rest of the world is not that silver prices will be manipulated again, but that the assumptions underpinning market behavior will remain unchanged despite clear evidence that the rules are evolving. And in the final part, we will bring these threads together, examining what this episode ultimately tells us about the future of markets. The role of state actors and how viewers can position themselves intellectually and potentially financially in a system where strategy increasingly outweighs transparency. When we step back and view China's 660-ton silver dump and abrupt reversal as a complete episode rather than an isolated headline, what emerges is not chaos, but intent, a carefully executed sequence designed to influence behavior, extract information, and reshape expectations without permanently destabilizing the system. This is what makes the event so instructive, because it reveals how modern markets are increasingly shaped not just by supply and demand, but by actors with long-time horizons, strategic patience, and objectives that extend far beyond quarterly performance. Silver was the vehicle, but the message was broader. Markets are no longer neutral arenas where all participants operate under the same assumptions. They are environments where power, discretion, and timing matter more than ever, and those who fail to recognize this risk mistaking surface-level volatility for randomness, when in reality it is often the result of deliberate action for viewers trying to make sense of what this means for the future. The most important takeaway is not whether silver will rise or fall next, but how similar tactics could be applied elsewhere, to energy, to food, to currencies, and to other materials essential to modern life. Once you understand that price can be used as a tool rather than a signal, your perspective shifts. Sudden moves become less shocking, reversals become more meaningful, and silence becomes as informative as official statements. This does not mean markets are rigged beyond comprehension, but it does mean they demand a higher level of awareness, one that goes beyond charts and headlines to consider incentives, constraints, and strategic culture. China's decision to reverse course after locking the market was not an admission of error. It was the completion of a cycle. Intervene, observe, adjust, and withdraw, leaving others to debate the meaning while the real objectives are already secured. For individual investors, analysts, and even policymakers, the challenge now is adaptation. Clinging to outdated models of market behavior creates vulnerability, while acknowledging the strategic dimension opens the door to better risk management and more realistic expectations. Silver's story is unlikely to end here. If anything, this episode suggests it will continue to play an outsized role as a pressure point where industrial demand, monetary uncertainty, and geopolitical ambition intersect. And the next major move may come when attention has shifted elsewhere, which is often when the most important signals appear. As you continue watching this channel, remember that understanding markets today is less about predicting outcomes and more about recognizing patterns of behavior. Who moves first, who benefits from confusion, and who has the luxury of patience. If this breakdown helped you see the silver market and global strategy from a clearer perspective, make sure to keep watching the next videos where we continue unpacking the hidden forces shaping the global economy. And if you want to stay ahead of these shifts as they unfold, Don't forget to subscribe to the channel and turn on notifications, because in a world where markets are increasingly strategic, insight is the real edge.